Steve Leisman, we were waiting to hear from you what you thought about the Atlanta Fed predicting 5% GDP growth for the third quarter.
Yeah, we did a pretty good study on that, and as Megan said, they have this habit of getting it wrong in the first quarter, in the first read off that first ISM report, and it's wrong by a lot, like 1.5 points or something like that. But we are still, that said, we're still have sort of strong forecast for the third quarter in that 3%. Remember, potential as far as anybody else is concerned is around 2%. Maybe it's 2.25% if you stretch it. So if we do 3%, that's a good number above it. It would be a little bit softer from the second quarter. And I'm looking, by the way, guys, at the Fed probabilities, and they're just slightly lower. I don't think meaningfully. Still looking at about a 90% probability now of a September hike, 63 for December, and then the next place where you get a greater than 50% probability is ahead to June 2019, 62%. So that's the outlook right now. It'll be interesting. I think that September meeting, and that's where I expect people to start to begin to set their expectations in a more meaningful way for what happens in 2019. We don't have a lot of guidance from the Federal Reserve. Our survey shows between 2 and 3 rate hikes out there, but the idea that the first one would come in May is a little bit late, I think, or June, and so that's where it's going to be important.
Well, let's go back to your, David, prediction that there will be 4 more rate hikes, September, December, March, and June. What is the potential, if you get that the economy will slow as a result of those rate hikes? And I made jest of the Fed and the president. If that happens, will the president then begin again to jawbone the Fed over precisely that? He'll say, I was right. They've raised it too much.
Well, that may happen, but I do think it'll slow the economy down. It'll slow demand in the economy down because by the second half of next year, you've got a bit of a fiscal fade. You don't have any more sugar from tax stimulus. And I believe the 30-year fixed-rate mortgage rate will go above 5%, and that will continue to slow housing, which is already looking a little soft. So yes, it'll slow down in terms of demand, but we've got no supply. They've got to do it because at that point, I think the unemployment rate will be below 3.5%. We're out of workers. We don't have that much of a productivity surge. So there's no point in pouring more demand into the economy if you can't meet that. So I think a balanced, reasonable strategy would be to get back to neutral on monetary policy.
Hey, David.
Yes.
David, the ADP numbers suggest no slowdown in the availability of workers. It seems like
it's strong people out.
I mean, I know this is stupid to say it, but 200,000 is seeming more and more like the run rate of the economy rather than some overstretched economy. We keep bringing in that many. I'm surprised. I know what you're saying. I know what the numbers are, but we ain't running out of workers anytime soon.
Well, I'm getting if you look at the sort of the year-to-year demographic drag of the retirement of the baby boom, it actually is getting worse. And the other thing is that we're seeing declining immigration month after month, 4 consecutive months now. The number of people entering the country on immigrant visas has fallen. So I actually think the demographic squeeze is getting worse. And if the unemployment rate comes down, then it still means, you've got to be a little forward-looking for the Fed. And if you've got below full employment, you do need to get back to neutral.
What do you think? 3 or 4 based on what you heard today?
So I actually expect fewer rate hikes, but whether it's 3 or 4, does it really matter? It's not a huge difference. I just think the Fed will be constrained by the long end of the yield curve and that they don't want to invert it, and so they'll have to go a bit more slowly.
How are you going to trade this tonight on Fast Money?
I tell you what, I don't think you do a whole lot on this news. We're obviously the market. Equities, first of all, if you want to impute higher interest rates and discount rates, and equity valuations matter, and I think if the Fed continues to hike, I think the multiple on the S&P should continue to contract. However, that's not what we're trading on. We're trading on trade, and we're trading on trade wars or the impact of them. Today's ISM, you heard from every part of the economy talking about both the impact of labor costs and shortage of labor, but also how they're gaming the tariff world. That's what the market is trading on. That's what we're all trading in the short to medium term.
How much are you paying attention to trade when it comes to your economic predictions?
A lot. And if you model the impact of a trade war, you get hardly any impact on growth or inflation at all. And I wouldn't trust that at all. Models don't know how to reflect disruptions in supply chains, things like that. And so I think the impact will actually be pretty significant, particularly in a drag on competitiveness for the U.S.
Downward session lows. You see? Go ahead, Tom.
How much more do you think the housing market is going to slow?
I think it'll slow a bit. I mean, the really key thing here is
prices will come down.
No, I don't think prices will come down, but we won't get any advance on housing starts beyond 1.3 million units. But getting back to the trade thing, I think this is absolutely crucial. The question is, will there be enough political pressure on on Washington to find some sort of trade war truce before the midterm elections.
No way. It doesn't help the elections. I mean, the bottom line here is this is an administration that has a lot of tailwinds to work with on trade in the economy, in terms of the market. And if anything, I think they dig in deeper. And frankly, China 2025 is the evil thing out there that everybody is chasing. And I think this administration will use that.
If I could just chime in, those tailwinds can go away real quickly.
They can, but does the administration...
Michelle and I had a good conversation yesterday. She asked me, well, the CNBC Fed survey shows about a 0.4% GDP percentage point decline from trade as forecast. She said, is that a big deal? Well, first of all, 0.4% of a $20 trillion economy, I'll take that any day, any day. Mm-hmm. But it also depends on what you have to work with. Yeah. If we're running at 4%, well, 0.4 is not a big deal. But if it's 2, 2.5, or even 3, that 0.4% is all of the extra you would have gotten from the tax cuts at most.
That's exactly the point, because this 5% from the Atlanta Fed, I think, is very wishful thinking. Yeah. In fact, if you look at vehicle sales today and you look at housing, it's slowing down. I think we're closer to about a 2 on third quarter, and if that transpires, then yes, 0.5% matters to growth.
Yeah. All right,
you're nodding, Megan.
I would agree with that. I would
Final
also
thought.
just say, in terms of trade, everybody's been really hopeful we'd have capex spending off the back of the tax bill, and now firms are all saying they're delaying and deferring capex because of trade policy. So the two are kind of wiping each other out.